I think we were right to wait and see how tariffs and inflation and the labor market evolved. There wasn't widespread support at all for a 50 basis point cut today. I think you could think of this in a way as a risk management cut.
Jay Powell speaking after widely expected quarter-point rate cut while dampening hopes of bigger reductions on concerns about the labor market. This is the Asia Trade. I'm Shery in Tokyo.
And I'm Annabelle, Droulers in Hong Kong. Chair Jay Powell keeping the Fed largely united despite President Trump's pressure for a bigger cut, with only new Governor Stephen Miron dissenting. Asian traders now digesting a well-telegraphed Fed move that left little impact on Wall Street, the dollar bouncing back from a fresh low for the year. Plus, Nvidia shares slip as China tells its tech sector to stop buying a chip that can be used for AI.
And Annabelle, it was pretty much as expected, a very measured Fed, with the dot plot now implying 2 rate cuts this year, one more than what was priced in before. And of course, all of this as we're now focusing on the cooling labor market, with inflation within expectations. Not surprising, the latest labor data, whether it's the jobless claims or the annual revision of the employment data, Chair Powell had this to say about what the job market in the U.S. looks like.
You go back to April and now look at the revised job creation numbers for May, June, July, and August. I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality.
Yeah, I think if there was really one big surprise out of this meeting, Shery, it was that we got one dissenting vote. Yesterday we were talking about maybe we could see as many as 4, but Jay Powell, maybe against the odds, managed to keep near consensus in the meeting. So just listen to him explain why that 25 basis points instead of the 50, which we know only Stephen Miron was advocating for. Take a listen.
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year.
And the reaction in the market was pretty muted, with some calling this a Goldilocks scenario for the markets, with the Fed delivering exactly what was expected. So we saw stocks and bonds falling marginally. It was a measured Fed. Some perceived it as a hawkish cut, and we were seeing the moves in rate-sensitive sectors and that rotation out of tech. But Chair Powell really dampening the recent rally that we saw in treasuries, and with yields now tracking higher across the board, we also saw the dollar rebounding, actually erasing those losses as Chair Powell began speaking at his press conference. On the other side of that trade, though, the euro at the strongest in 4 years ahead of this decision, of course, with that prospect of more Fed rate cuts to come and expectations that the ECB won't cut further. We had this diverging expectations for both central banks, really leading markets to think that perhaps we could see that 120 level being achieved for the euro. And you can see the gold also at the moment holding steady, but this after falling in the previous session from a fresh record high as the dollar continued to strengthen. So take a look at how we're setting up for the Japanese market opens, because we had seen the yen really gain ground against the U.S. dollar towards that 145, but just reversing all of those gains and now holding steady at that 146 level, as the Nikkei also fell from those record highs. And of course, we'll be watching the JGB price action as well after a solid 20-year auction and headed towards a BOJ policy decision.
Yeah, really bookending the week there, the BOJ coming up on Friday. But let's dig into the outlook for the Fed. For the markets now, bringing Infrastructure Capital Advisors CEO and CIO Jay Hatfield joining us from New York. And also along with us is Bloomberg senior editor and opinion columnist John Authers. John, I'll start off with you, because yesterday we were talking about, again, how to be a fly on the wall during this meeting. The stage seems set for a lot of fireworks. But if anything, it seems to have kind of come off a lot differently than what some had expected.
Well, it's certainly at the margin somewhat more hawkish than people thought it was reasonable to expect going into it. And I agree with you, Annabelle, that the single most interesting and surprising data point is that only Stephen Miron dissented. Christopher Waller has an extremely good chance of being nominated to be the next Fed chairman. he would have helped his chances by voting for a jumbo cut of 50, and he didn't do it. Neither did Mickey Bowman, who also has some chance of that. That is quite interesting, quite telling. And unfortunately, because this is the kind of thing that it's very difficult to gauge, in many ways, what matters most now is the very confused picture of who's going to get the nod to be the Fed chairman. If you believe the prediction markets, we have gone from Christopher Waller being the narrow but clear favourite to a neck and neck race involving Stephen Mirren and Christopher Waller. That's unfortunately is the big element of uncertainty for the next few months.
Despite the longer-term prospects of the Fed composition, Jay, when it comes to this rate decision, was it perceived as a hawkish cut, and does the market reaction make sense?
Thanks, Shery. It's great to be on. Well, it was a close call between being totally in line and slightly hawkish. I will say the bond market sold off. For everyone who has a terminal, I'd look at MIPR. And so look at the terminal rate, which is roughly 308. A couple of days ago, that was as low as 290. So terminal rate being where the Fed will ultimately cut to. And that's the key determinant of the 10-year. So supports John's view that it was slightly hawkish because you did see both the bond and stock market trade off. The bond market, both Fed funds and the 10-year trade off a little bit. But we were relieved. We thought it could be way more hawkish because of the Democrats/Keynesians on the committee. But they're really worried. The labor economists are worried about the labor market. The more monetarists are not worried about inflation because the money supply is shrinking. So there is an agreement between the two camps, even though they're sharply divided politically. And so that was a relief. And you saw it was more of a rotation, pretty strong rally. Like I'm looking at my screen over here to the left, and it's full of green. So it was pretty broad-based rally and just had a little bit of selling of tech stocks, and then the futures are up. So I think it's a relief to the stock market because it could have been way more hawkish.
John, does the relief, though, could that be short-lived if, in fact, the labor market is cooling and this could be a further risk for consumption in the U.S.? What is the economic data backdrop telling us about the potential for monetary policy to change more going down the line?
Very much so. Part of the reason that they have left as many options open is because the data is difficult to read and quite confusing. I can perfectly easily imagine a scenario where over the next few weeks, initial claims rises further week by week. And by the next FOMC, it's obvious we really do have a problem with a growing problem with unemployment. I can also imagine a scenario where after another couple of CPI readings, the long feared tariff effect is beginning to show up, and that it wasn't tariff derangement syndrome overall. But yeah, the obvious concern at this point, which is why we didn't get a more hawkish steer, is that lies in the unemployment. It looks as though it might be turning badly. Not totally clear yet, and they came to, I think, a quite reasonable consensus that 25 bips leaving options open was probably the most responsible way to play that. But as you were saying at the beginning, it's quite impressive. Jay Powell does have certain great political gifts. He managed to steer this one as well as he seems to have done was quite an impressive feat, whatever else you think about his record as an economist. This was this is a reasonably impressive display of unity.
Yeah, absolutely. I mean, as we said, really seems to have been a little bit against the odds. But Jay, I'll bring you back in on your upgraded forecast for the S&P 500 because your year-end target for this year is now at 7,000. Next year, you've raised it to 7,700. That, I guess, is sort of off the outlook around corporate earnings. But at the same time, if you have that have held up, but at the same time, if you've got that weakening labour market, when does that then start to play into the corporate earnings picture as well, corporate profits?
Well, we, unlike the Fed, actually forecast economic data versus looking at deeply delayed data. And so what we use to forecast is the 10-year. That's the critical financial condition, and resulting mortgage rates. And those have come off 90 basis points in the last, really since the Jackson Hole speech. And so that's super bullish for a recovery in the housing sector. And the reason we had correctly believed that that the employment market was weakening was because housing was really starting to go into a recession. We had weak starts today, but we think that's going to really reverse. Refinancings are up. Mortgages at 6 is all steam ahead for the housing market in the U.S. So we think the labor market will stabilize and housing will be a tailwind next year. And so we'll get 3% growth, which supports our fairly aggressive targets because they both imply 23 times S&P earnings.
And which sectors then are you favouring in particular, Jay? Is it still the sort of big tech theme that has been, of course, the standout, really?
Absolutely. I do think, though, that so I wouldn't sell all of your tech stocks. And it's important to note that if we're correct about the market, you want to be in the riskiest stocks. So tech stocks typically have the highest risk or beta. So it's not so much that other stocks will outperform, but when rates are coming down, small caps do well. We have a fund S-cap in that sector. It's been doing well after the Fed started to become more dovish. And then also financials, they've been performing really well, particularly investment banks, private equity firms. But we would be more risk on. So financials are risk area, industrials, REITs are risk on, and avoid the sectors that are more defensive.
And John, the Fed just sets us up to rate decisions out of the Bank of England, out of the Bank of Japan as well. What will be top of mind for you going into these decisions?
Well, the Fed has just made things very slightly easier for other central banks by easing a bit, but still leaves things fairly up in the air. The Bank of England, back home in the UK, there is a real cleft stick given the fiscal situation, given the way both unemployment and inflation are too high for comfort. My best guess, it's really not going to be possible for them to cut the bank rate. You might see some big change to quantitative tightening to their attempt to rein in the balance sheet. But that is the Bank of England has been a very openly divided monetary policy committee for quite a long time. And so that we've had times when there've been 3 different ways that the vote has gone. Last time they actually needed 2 votes before they could come to a decision. So it's not an easy one to call, but I think the greatest interest is going to be on whether they really do try to cut back the moves on QT on the bond market. In Japan, there's some politics going on in Japan too. I don't think we're going to get a big move this meeting, but plainly the signalling is very important. With Japanese inflation is in a place that I haven't seen in my career. And that will require some fairly considerable recalibration of policy. And given how much the rest of the world relies on Japan for this seemingly eternal stream of cheap money, they've got to do it very steadily and very carefully.
John, great to have you with us, and also Jay as well. That was Infrastructure Capital Advisors CEO and CIO Jay Hatfield, as well as Bloomberg Senior Editor for Markets and opinion columnist John Authers. And we'll have a lot more analysis on the Fed coming up on the Asia trade with UBS and also Man Group. Plus, the EU Justice Commissioner joins us to unpack the bloc's trade ties with Korea and Japan. We'll have plenty more ahead. This is Bloomberg.
We have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year.
Fed Chair Jay Powell on the impact of tariffs on inflation. Of course, we have seen a more measured Federal Reserve, with Chair Powell also talking about a slowing and cooling job market. Take a look at how currencies are setting up. The Bloomberg dollar index holding steady after we saw it fall to this year's lows, erasing those losses as Chair Powell began speaking, tracking yields higher. The euro still at the highest level in about 4 years, with expectations of that divergence with the Fed cutting rates and the ECB holding steady. And you can see, of course, the pound right there as we're headed towards the Bank of England policy decision as well. President Trump has begun his UK visit with a lavish state dinner hosted by King Charles and attended by the CEOs of Apple, Citigroup, Nvidia, and Blackstone. But the real business begins later Thursday when Trump meets with Prime Minister Keir Starmer. Joining us now is Bloomberg's digital politics editor, Romy Varghese. Romy, so what's on the agenda when Trump and Starmer meet?
Yes, it's going to be a bit of a different tone than today, where we had a lot of pomp and circumstance and fancy food and a specialty cocktail. Today, later on Thursday, Trump and Starmer will meet to talk about various policy issues. Top on the agenda will be announcing tens of billions of dollars in new investment in the UK, which Starmer is very happy about. But we also expect discussions on tariffs and the war in Ukraine. But our colleagues are reporting that we are not going to really see any major breakthroughs on these topics. London has already backed off, thinking about, having a goal of eliminating the tariffs on British steel to zero. They've backed off on that goal. So we're not expecting for these major geopolitical issues major breakthroughs. But for Starmer, this is a really good meeting because he gets to show his constituents that American companies are investing billions of dollars in the UK.
Yeah, and some of those companies that are doing those big investments are from the Silicon Valley side as well. So how is Keir Starmer setting himself apart then by welcoming that cohort?
Yes, this is a very interesting approach by Keir Starmer. It's very different than what's happening in France with Macron, for instance. Macron is promoting homegrown French AI firms. Starmer is welcoming Silicon Valley. He wants to see this U.S. investment. He's talking about facilitating these data centers. And for Starmer, this is a really good idea to show his people that, hey, we are going, by welcoming these American firms, we're going to create thousands of jobs.
That was our Bloomberg digital politics editor, Romy Varghese there. And sticking on that topic, of course, because whilst Jensen Huang has been in London, at the same time, China's also widened its clampdown on Nvidia chips, instructing domestic companies to halt orders for a particular workstation chip that can be repurposed for AI uses. For the latest, let's bring in our Chief North Asia correspondent, Stephen Engel in Hong Kong. And Steve, this sort of follows because we've already had not an outright ban, but at least companies being discouraged in China from using H20.
Right.
But this is a different chip. So what do we know about this one?
This is the RTX Pro 6000D, which is specifically designed for China not to trigger those export controls that the United States put in place. Of course, the H20 was banned from selling to China. Then it's been resurrected. Then suddenly after that, China said they didn't, as you rightfully said, they didn't outright ban Chinese firms from buying it, but they sort of instructed them to exercise caution. Obviously, they're concerned about any potential backdoor security risks and the like, but also possibly bargaining chip. We can talk about that a little bit later. But the RTX Pro 6000D is a chip that is not considered high-end AI chip. It's not specifically as powerful as the H20. It's more of a workstation chip that can be repurposed for local, smaller scale modeling and fine-tuning. And the Chinese are buying these, but maybe it's not as critical as the H20 or other chips. But it also potentially sends a signal at a time, of course, when the U.S. and China are negotiating a trade deal, possibly lining up a summit between Donald Trump and Xi Jinping. They're also sending a signal that their domestic chip industry is stronger now. T-Head from Alibaba and other chips possibly can do the work of the RTX Pro 6000D. So it's either sending a signal that way, that they're confident, or maybe they're just establishing that bargaining chip.
Yeah, exactly. Given that, of course, we could see the potential Xi-Trump summit, right? What are we expecting?
Yeah, so everyone wants to have leverage, okay? And everyone wants deliverables in any Xi and Trump meeting. So again, maybe this issue with Nvidia is getting caught in the middle, because at the same time in the last week, we've not only had a antitrust ruling by China against Nvidia for its $7 billion purchase in 2020 of Mellanox Technologies, we've had two other separate investigations launched within the last week by the Ministry of Commerce, one an anti-dumping one on the analog integrated circuit chips, as well as an anti-discrimination probe launched by the Ministry of Commerce against the overall U.S. approach towards restricting chips to China. So there is lots of movement going on against the U.S. chip industry right now. That's one reason why, again, you saw Nvidia stock overnight down, other pressure on the chip industry, whether it's AMD, Micron, I think, was up. But again, Jensen Huang, we mentioned he is in London right now, accompanying Donald Trump on his trade mission to the UK. This is what Jensen had to say when asked by the gaggle of reporters about the latest developments overnight in Beijing. I'm disappointed, he says, in what I see, but they have larger agendas to work out between China and the United States. We can only be in service of a market if the country wants us to be. That's direct from Jensen Huang in London.
Yeah, I mean, it's really interesting, as you said. Is it the bargaining chip, or is it just China wanting full stack China AI and full stack China tech? Well, that was our Chief North Asia correspondent there, Stephen Engel. And actually, aside from that story this week, another big story in the tech space as well has been Jack Ma's return to the Alibaba's campus, now looking the most involved in the company that has been in half a decade. So we've got a special Q&A on that coming up later today. That's the future of tech, AI in China, with Jack Ma back and Alibaba. So tune in on that. That's going to be via the website or on Bloomberg.com. More ahead. This is Bloomberg. You're watching the Asia trade, and one of the areas we're watching this morning is the New Zealand dollar, because you can see here pretty sharp tumble against the dollar, nearly 1% over 2 days. But what is feeding into that trading sentiment this morning is the GDP data that we got out just in the last couple of hours. But the big headline and the key takeaways from this is that it came in quite a bit worse than expected by economists, both on a year-on-year basis, also a quarter-on-quarter basis as well. So that is possibly setting the stage for the RBNZ to need to ease further in the months ahead. Of course, the RBNZ was the front runner in the interest rate cycle. But we'll have more ahead on the Asia trade. This is Bloomberg.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Let's bring in Arend Kapteyn, Global Head of Economics and Strategy Research at UBS, to break all of this down for us. Of course, we have seen some indications, Arend, great to have you with us, that the Fed chair was able to choreograph this meeting really well in terms of the statement and also a more balanced presser. What was your key takeaway?
Yeah, so a few surprises, I think. So obviously all the focus was on the dots and where would Stephen Moran's dots show up. And I think what was interesting there is that obviously the dots for this year were arguing for 350s, but then he's aligned with the rest of the committee for the subsequent years, and the landing zone seems the same. So he seems to be arguing to just get there a bit quicker. So that was sort of the first thing that was a bit surprising, that in the subsequent years there were really no new outliers. Second thing is the statement was a real shift in terms of the concern about the labor market, but then you really didn't see it in the forecast, and you also didn't really see it in the risk assessment, which is at the back of the summary of economic projections. So the number of people who were sort of thinking it had become riskier or more uncertain didn't really go up. So that was a little strange. There were some contradictions between really I think the forecast and sort of the language. And the final thing is, we thought we'd see more dissent. So the state of the labor market is very, very weak now. I think there's a real risk of slipping into contraction, probably by the fourth quarter or so. And yet there was only one vote for a 50.
Although the statement seemed a bit dovish, we did see Chair Powell trying to frame that and the outlook as being more balanced. So what does that tell you about what the Fed chair is trying to do? And also, does this give you also indications of what might happen after May, given that you mentioned that 50 basis points vote coming from Stephen Moynihan as well?
Yeah, I mean, he framed it as sort of, being more in balance. The statement sort of didn't make it seem that way, and in our mind, like what they were thinking in June is sort of flipped on its head. So in June, they clearly, they hadn't seen the bad labor market data yet. That was when the pass through from the tariffs was about to start, and so they were clearly much more concerned, I think, about the inflation data than the employment data. And now it's the opposite. And so to sort of say that they've become more imbalanced seems a little odd, but it seems like they just want to get out of the way, which is to say they want to just be neutral. There's not a lot that their interest rate policy can do about these tariffs. I think this is probably a short-lived sort of period of weakness, and they just want to remove the restrictiveness. And I think it's too early to actually become accommodative. So I think they know where the end point is, and they're trying to sort of come up with the right language to sort of tell us that that's where they're going to go.
What about, you were saying that we could have expected more dissenters. I think a lot of people, for instance, were looking at Governor Chris Waller, Governor Michelle Bowman as well, given they dissented in the last meeting. The fact that they didn't, and we only had Stephen Moynihan that did, does that sort of also set up a lack of clarity or uncertainty around who could be the next Fed governor and the path that we're expected to take? Because yesterday, really, there was still that overall projection. We would be setting up for a much more accommodated path.
Yeah, I mean, on one level, you could sort of say, back at the July meeting, Bowman and Waller dissented because they wanted to cut and no one else wanted to, and now everyone has joined them. So you could sort of say they got what they wanted, and hence there was no need for them to dissent. But yeah, I think a lot of the pre-meeting speculation was that there is sort of a little bit of an element of, you're sort of signaling with your dots right now, sort of how dovish you're able to be, and maybe that then has some impact on the likelihood of you potentially being nominated. I thought it was interesting right after the meeting, you could sort of see, actually Bloomberg was reporting all the betting odds, right? How the betting odds for the next Fed chair had shifted based on how the dot plot has sort of come in. But so yeah, that was a little surprising, but I think frankly there's so much uncertainty right now. I think you can just as easily make a case for doing a 25 or a 50, and so it was surprising, but I think defendable.
What about a very big action-packed week for central banks? BOE is coming up as well. What are your expectations there?
Yeah, they're a little bit trapped. So there's a very tight vote in August. They basically have been a bit unlucky, I think, on both the price and the wage data. Now, part of that's self-inflicted by the government, right? So they passed some national insurance tax increases early in the year. That's adding a lot to inflation, which has actually made it harder for the Bank of England to keep cutting. And so now we're likely to go up a little bit higher on inflation into September. That'll be the peak. And then they have to really wait for the budget in November and to see whether that budget then is a repeat of last year, potentially inflationary, or whether it's actually disinflationary and growth reducing. So the market's basically priced out the likelihood of them cutting this year and subsequent cuts, which I do think will come, because I think the forward-looking indicators are looking much better for next year, but they may have to delay those cuts till to next year rather than doing them later this year.
Arend, the Bank of Japan also a bit trapped, high inflation, but of course high political uncertainty as well.
Yeah, so for a lot of these central banks, we're now going into a 4-6 months period where we're going to start to see the impact of the tariffs. So, and to some extent, we're assuming that the central banks want to wait to see that. So we think, while growth and surveys right now in Japan look pretty resilient, and we had some upward revision to the second quarter data, we think we're going to slow now. So both inflation and growth are going to come down. Which is why we thought they'd want to wait and not move at the at this week's meeting or indeed even the October meeting. The other thing that we think, other than sort of some of the political uncertainty they'll be looking at, is the Fed and what happens to the currency. So if the Fed is cutting aggressively and dollar yen, or basically the Japanese yen, starts to sort of appreciate, that would do some of the tightening for the BOJ, and then there's sort of less of an urgency to hike rapidly. Conversely, if that doesn't happen and the yen continues to stay relatively weak, then maybe there's an argument to pull some of those hikes forward. So we don't have the next hike until March of next year. I think we're open to sort of having to pull it forward a little bit, but I really don't think a hike is likely at the next two meetings.
Arend, thanks very much for joining us this morning. That was Advisors Kapteyn there, Global Head of Economics and Strategy Research at UBS, and some other central banks that we're following this morning as well. Well, the Bank of Canada has cut its key rate for the first time since March. That's as the economy and jobs market show damage from US tariffs. Officials cut the benchmark rate by a quarter point to 2.5%, which was in line with expectations. The BOC offered little forward guidance, but traders continue to fully price in another cut from the central bank this cycle. Bank Indonesia has delivered another surprise interest rate cut, lowering its benchmark rate by 25 basis points to 4.75%. The move signals the central bank is behind President Prabowo Subianto's bid to galvanize growth following widespread cost of living protests. Bank Indonesia says its monetary policy will be pro-growth and didn't mention concerns about possible changes to its mandate. Taking a look at the EMFX, or emerging markets currencies rather, this morning, you are just seeing, fairly muted so far today, but it's going to be a big question around the dollar. Of course, we saw some dollar strength after the central bank's announcement. That could play into Asian currencies, maybe a little bit unlikely to escape the impact of that, or at least that's what Wells Fargo is saying as well. The dollar as well, we could be looking at against the Japanese yen, given, of course, you've got that BOJ coming up, and some are saying that 147 is possible. But there you see, EM currencies are fairly steady so far. But let's bring in Bloomberg MLI strategist Mark Cranfield for a preview of the market open in Asia post-Fed decision. And Mark, it was kind of a muted reaction that we saw on Wall Street overnight. Are we expecting the same in Asia today? Or, given you had so much optimism yesterday in the session around Chinese tech innovation, does that also play into the picture as well?
Ah, well, there you go. It's the Chinese tech story, which will probably take a bit more relevance than what the Fed did, as the previous guest was saying, pretty much in line with most expectations before. But even so, overnight we saw again the big tech names, China, that trade the ADRs. They were up again. Alibaba, Tencent, they rose again in overnight trading. So you'd imagine some of the optimism will filter through into Asia today. So very much where the direction of the Chinese markets go will be what the rest of Asian stocks will be looking at. And it looks like it's set up for a positive start. On a relative basis, a lot of people still think that Asia has a lot of catch-up to do with the United States. Those markets keep on setting records, and yet Asia, by comparison, the metrics are certainly not as demanding as what you're seeing in the US. So it'd be surprising if we don't get a decent start with Asian markets today. And don't forget, when you look at the overall picture here from the Federal Reserve, the standout is the fact that the Federal Reserve is projecting interest rates to go down to something like 3% by the end of 2027. But when you look at the mix now, the Fed, Stephen Mirren is already on board. There'll probably be some more changes to the Federal Reserve next year. Investors will be thinking that 3% target will become much further forward. It's unlikely for Fed people to be waiting until 2027. So now investors will be thinking, how quickly can we get to 3%? And those dot plots may need to change substantially as we get into early next year.
And Mark, here in Japan, we're setting up for the Bank of Japan policy decision after a solid 20-year auction. So what should we be watching for the session today?
It's really all about the signaling from Governor Ueda when he steps up to the press conference on Friday, whether or not he can solidify a case for rates to go up in October, or is it going to be slightly later? As the previous guest was suggesting, the market is pretty split here. Some people, we've got a coin toss for December. If you look at the pricing currently in the markets, we're thinking that December is a good chance for a BOJ hike. Some people think it'll be early next year. But there's a sense of urgency about Governor Ueda. I think he sees the possibility that there's a political window for him here. The LDP race is coming up. They're going to have their decision just before the BOJ meet in October. And I think he's coming to the conclusion that there'll be some conclusion to the LDP race where it'll be clear who's going to be the next prime minister. He's got a little window where he could push through the rate hike in October. If he used that signaling at the decision this week, that'd actually be positive for the yen. That's not fully priced into the market by any means, probably slightly negative for JGBs. But it's the yen that will have the biggest reaction because traders have been pretty sleepy on the yen. If you look, it's been just drifting around the 147 level, got a bit below it this week. But a lot of people are just not trading the yen because there's no clear signaling. But Ueda could change everything on Friday. He could set up October as a live meeting, and that is not fully priced into the market for the time being.
Yeah, especially as you say, given that we need to have the LDP vote on October 4th and then the October 30th BOJ policy decision. Mark Cranfield, good to have you with us, Bloomberg NLive strategist, and we do have more ahead on the Asia trade. This is Bloomberg.
We're going to be watching shares of Santos when trading starts in Australia. That's after the Abu Dhabi National Oil dropped its planned $19 billion takeover of the company. Bloomberg's Kira Wright joins us for the details. And Kira, why exactly did this happen?
It's a very good question. I think that it's caught everyone by surprise a little bit. So last night, ADNOC cited disagreements on some key terms, including specifically the valuation of the company and also some unexpected tax liabilities, but it's still, there are a lot of questions remaining at this stage.
Santos has struggled for years to find a suitor, so how bruised will shareholders be?
Yeah, I mean, I think that we're certain to see some momentum, negative momentum rather, this morning when the Australian stock market opens. We've already had some analysts flag this morning that they're expecting the stock price to be fairly weak at the open. And of course, as you say, Santos has, they've struggled quite a bit in the last few years. This represents the third failed tie-up attempt for the major gas company in Australia. So I think that there will be some questions for them this morning.
ADNOC pulling out also came at the same time. We saw a lot of opposition within Australia as well. What's next then, do you think?
I think that that's yet to be seen, but I think that something that folks will certainly be looking into is whether any potential future suitors emerge. Another thing that people also have been speaking about here on the ground in Australia is a potential spin-out of some of the domestic gas assets that Santos owns. Santos is quite a complicated company. They've, of course, got their liquefied natural gas assets, which are the component of the business that is exported but there also is quite a significant domestic component there. So potentially there could be a spin-off happening as well in the future.
Kira, really great reporting there. And of course, we're watching Santos, as we said, when trading starts in Sydney in about 13 minutes from now. But that was Bloomberg's Kira Wright. Another corporate story we're tracking as well. Tesla says it's working on a redesign of its door handles. That's following a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. The firm's design chief told us Tesla is looking to combine the electronic and manual door release mechanisms, which are currently located separately. Earlier this week, the US auto safety regulator opened an investigation into whether some Tesla doors are defective.
And take a look at how we're setting up for the Japanese market opens. We could see a little bit of a pop after the Nikkei fell in the previous session. We're seeing futures higher by 0.4%. The Japanese yen holding steady after strengthening in the overnight session and giving up all of those gains. Watch the JGB space after that solid 20-year auction. One stock that we'll be watching in today's session, Japanese shipping giant NYK. Top executives saying that they're paying close attention to investor relations as activist investors ramp up governance campaigns. In the latest episode of Bloomberg Chief Future Officer CFO Akira Kono and CEO Takaya Soga told us they're allocating more capital to dividends and buybacks.
In order to grow our operation, we need investment. So now it's a kind of a balance. We reserve some portion for the new investment, for the growth. And the other part, we return our profit to our shareholders. And our current market cap is not so satisfactory. So that's one of the points. And we decided to increase the distributions and also the share buyback.
Do you have a target in mind when you think about your market cap?
At the moment, our PBR at below the 1.0. So then I think at least our company's value and enterprise value should be more than 1.0.
There's another reason NYK is paying close attention to investor relations right now. Shareholder activism is on the rise in Japan.
We have not received the shareholders' proposal at this year's General Assembly meeting, but basically, when I have the IR, investor relation meeting with the Japanese investors and the foreign investors, sometimes they pointing out the low ROE and the return on equity, and also the disclosure on each business sectors.
We are doing a very, very necessary investment on our future growth of our value. At the same time, we also pay the return to the shareholders at the same time.
Does it at the same time also help keep these activist investors who have been very active here in the Japanese market recently at bay?
That is one of the ways of protecting ourselves, I think.
NYK CFO Akira Kono from the latest episode of Bloomberg Chief Future Officer. You can catch that episode at 9:30 p.m. in New York, 7:30 p.m. Thursday night, Hong Kong time, if you're watching in Asia. But we do have breaking news at the moment here in Japan. We are getting the July core machine orders data, and it's a contraction of 4.6% month on month, a much bigger contraction than was expected. Of course, this is a very volatile set of numbers. We had seen contraction for some months of the year, some expansion, but we're back into contraction territory. And year is also growth of only 4.9% coming in below estimates. Remember, July is when that trade deal with the U.S. was struck, but of course we continue to have those tariffs higher at that point. More ahead on the Asia trade. This is Bloomberg. Disney's ABC network is taking Jimmy Kimmel live off the air immediately after a backlash over the late-night host's comments about the killing of Republican activist Charlie Kirk. Let's bring in Chris Palmieri for the latest on this story and a very heated political climate over in the U.S. What exactly happened?
Kimmel made some comments about the alleged shooter, the assassin of Charlie Kirk, suggesting that he was also MAGA, part of Donald Trump's movement. The chairman of the Federal Communications Commission was on a podcast and said this was inappropriate. Nexstar Broadcasting, one of the largest station owners in the country, said that they were taking Kimmel's show off the air, and Disney followed suit immediately thereafter.
I mean, you can't really underscore the significance of this. Jimmy Kimmel is one of the network's biggest stars. So how long do we know this is going to last? And again, what does it sort of tell you about the environment for major networks in the US as well that sort of need to balance, I guess, freedom of speech against also trying to not make overly inflammatory remarks that also upset the Trump administration?
Right. Well, we've certainly seen this before with Stephen Colbert being, his show is going to end, and that was, ostensibly blamed on the cost of operating it, but was also tied into a review by the FCC of a parent company's merger. We've also seen more recently someone, regular commentator on MSNBC taken off the air because of his comments regarding the Kirk assassination, and we've seen lots of people even outside of media losing their jobs or being suspended because of comments about this. It's a very, very sensitive topic.
Yeah, extremely sensitive. And as we said, Walt Disney's ABC network is going to be taking Jimmy Kimmel live off the air, and that's indefinite amid his comments or backlash over his comments made about the killing of Republican activist Charlie Kirk. So thanks very much for joining us, Chris, to break that down for us. That was Bloomberg's Chris Palmieri there. And quick check on markets ahead of the open here. We are counting down to the start of trade in Sydney, Seoul and Tokyo. The session today may look a little bit more muted. It follows what we had on Wall Street overnight. The Fed decision, yes, a 25 basis point cut, but coming in largely in line with what economists and analysts had been expecting. Lots of focus too, though, on China tech, given we saw a big rally in the session yesterday. Can that extend? We'll have more ahead. This is Bloomberg.
Trade, we're counting down to Asia's major market opens, and the reaction to the Fed rate cut very much in line as market expectations. Bell, we're talking about that 25 basis point rate cut, and the dot plot now implying 2 more rate cuts this year, 1 more than projected in June. The focus very much on the labor market.
Yeah, absolutely. It seems like that focus is firmly on that weakness that we're seeing and overriding any concerns around inflation that the Fed still thinks could tick a little bit higher. But also, I think if we want to talk about the takeaways from the meeting, you can't forget just one dissenter. Yesterday, we were talking about as many as 4, but it was Stephen Myron, of course, that agitated for a larger reduction.
It was funny how Chair Powell tried to downplay that, saying that for one voter to really persuade the entire board that he would need to be very, very persuasive. But take a look at how Japan is opening right now, because, of course, we had fallen from those record highs, but we're seeing a little bit of an upside early in the session, up 0.3% for the Nikkei as we're headed towards a Bank of Japan policy decision as well. We did see core machine orders, though, surprising to the downside, a contraction bigger than economists had expected, but that's a really volatile set of numbers. So we're watching the Japanese yen holding at that 146 level. We saw some strength in the overnight session towards 145, but recouping most of those gains against the greenback. And we're watching the JGB space as well after the 20-year auction that saw the strongest demand since 2020. Take a look at how South Korea is also coming online. We heard from policymakers there that they see limited impact from the Fed's rate cut, and that they're also closely monitoring household debt and tariff impacts as well. Take a look at the Kospi gaining 0.6% right at the open, and the Korean won holding at that 1380 level. We actually saw some foreign outflows from the South Korean market after inflows for consecutive days this past week. Annabelle.
Yeah, Korea, of course, really one of the standout bourses in Asia. But also let's take a look at what's happening in the Treasury space today. Yesterday it was really kind of that overnight knee-jerk reaction that we saw. So sort of initial expectation we might see some further easing to come. But as you got those dots coming out, you had the press conference as well. We actually saw yields just settling a little bit high here. So you can see here fairly steady as we get online with the start of trading in Tokyo rather this morning. But Jay Powell spoke about the rationale for 25 basis points instead of 50. Take a listen.
I think you can think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
For more, let's bring in Kristina Hooper, Chief Market Strategist at Man Group. And Kristina, what did you make from the decision overnight? Because when I read through your notes, it's quite clear that you think that there are some risks on the horizon that maybe other investors or traders aren't appreciating or factoring in right now.
Absolutely. I think that what we're seeing are a number of different canaries in the coal mine. We're seeing a weakening of lower and middle income households in terms of the level of their spending, but also the pressures that they're facing. We're seeing an increase in delinquencies in credit cards, in autos. So the picture is one of an economy that's coming under increased pressure. But to be fair, what Chair Powell is looking at is labor, and labor is weakening enough to justify 25 basis points. I don't think it justifies any more, just because the Fed is very much a data-dependent central bank. So they're going to need to see enough more data to be convinced of doing more cuts, which I think is fair. Having said that, though, I do think the U.S. is heading towards recessionary conditions.
Kristina, just hold that thought. I've also just got to mention some breaking news just crossing the terminal here relating to Santos. We were just talking about this deal in the last few minutes, but Santos, ADNOC has walked away from around a $19 billion deal to acquire the company. Santos says this is, or ADNOC rather says this is for purely commercial reasons, but still Santos as a company has struggled to find buyers for years, even though there was opposition to this specific deal in Australia as well. But we are seeing that stock very much under pressure as Sydney trading gets underway this morning. But Kristina, let's go back to that discussion around the sort of recessionary risks that you see on the horizon. What are you most concerned about right now, and when does that as well start to factor into earnings projections?
I'm actually most concerned about the labor market as well. What we've seen is a pretty significant increase in long-term unemployed, those out of work 27 weeks and over. Now, some might dismiss that as unimportant because we do still have a high level of job openings relative to the number of unemployed. There's almost a match. We saw unemployed exceed just slightly the number of job openings in the last month. But I think what that speaks to is that there are probably a lot of job openings that are under the skill level of those seeking those jobs, under the pay level of those seeking those jobs. You know, I haven't looked at long-term unemployed metrics since we were coming out of the global financial crisis. That was a jobless recovery, if you recall, and it took years for the labor market to come back. So the weakening in the labor market that I'm seeing now is very concerning. We know that there are a lot of households in the United States that live paycheck to paycheck. And so receiving a pink slip, losing their jobs can be really, really problematic. So there's already pressure. Many households are once again paying student loan interest, servicing their debt, and losing a job is only going to add to that pressure. We also have inflationary pressures on lower income households. So it's a difficult picture. It's not to say that there isn't the potential for the U.S. To keep going, but my base case is that we'll see recessionary conditions.
Do the economic risks change your market outlook? Because now with more Fed rate cuts being priced in, we actually saw a rotation out of tech into value stocks, into small caps, into rate-sensitive sectors as well.
I think we have to be careful with that rotation because what we heard today from Chair Powell was a caveat that don't assume we're in the midst of a rate cut cycle. And certainly if we were to look at the dot plot today, what we see is a very shallow cut cycle anticipated. One rate cut in 26, one rate cut in 27. That's not the kind of fuel that really powers a stock market engine, particularly small caps and cyclicals. So I think we want to be careful there. Now, having said that, if we see the composition of the Fed change, if the White House gets what it wants and has far more doves on it, then we could very well see some rocket fuel.
What does that mean for Asian markets? Of course, central banks around the region are getting a reprieve from the fact that the Fed finally has restarted its easing cycle. We have seen an incredible rally already in the Asian assets, but with the economic risks, is that more of a concern now?
So I think that what we're seeing from a lot of Asian economies is strength, domestic strength, but a lot of concern around the impact of tariffs and what that might hold for them. So I think that's really the most important factor right now that will determine the future. And I think we're already seeing different policies being rolled out to ameliorate the impact of tariffs. We have China fiscal stimulus, and it's not just the stimulus intended to spur on domestic demand, but we're also seeing stimulus in the form of a really significant increase in defense spending. China released a target that's very significant. I think it'll exceed that for 2025. So we do have forces at work that are likely to be very positive for Asia in general, not just, for example, China.
So which markets then are standing out to you? China is one clearly, but which other ones in Asia?
Well, certainly Korea looks great, but that's already had a very strong run-up. Japan, I think there's real potential there. I think the Bank of Japan is going to be very thoughtful. It will be heading in the direction of hikes, but I think it will be slow and measured, and that should be supportive of the economy. I think we've seen some significant structural changes in the Japanese economy that are likely to create longer-term benefits.
What does that mean for the Japanese yen? Because we have seen, of course, exporters getting bid when you have weakness, but the yen has been really range-bound in the last few months.
Well, I think we will see the yen continue to be range-bound, perhaps push a little up, especially relative to some of the currencies where we're seeing central bank cuts, namely the U.S. But again, I think we are going to see something of a shallow rate cut cycle. So I would anticipate, relatively range-bound yen going forward, but certainly on the margin stronger than the dollar.
Are there any sectors that you're paying attention to, given, of course, the monetary divergence that we're seeing from the BOJ and perhaps the rest of the world as well?
Well, one sector that I'm paying close attention to is technology. I think that we've seen a pretty significant sea change this year, a recognition that China has made incredible technological advances that perhaps have been overlooked. And the DeepSeek announcement rejiggered attention back to China tech and its potential, especially with far more attractive valuations in the U.S. So I'm certainly positive on U.S. tech. I think there's a lot of potential there, but I also think there's potential for investors in taking some of the profits, some of the exposure in U.S. tech and diversifying, adding exposure to China tech. There's a lot of strength. There have been really significant advances in certain industries that make China tech very attractive to me.
Kristina, thanks for joining us this morning. Kristina Hooper there, Chief Market Strategist at Man Group. And let's go back to what's happening in the start of trade here, because 10 minutes into the session, also taking a look at the movers over in Sydney. And if there's one that's standing out to us, that's well and truly Santos there. You can see down nearly 12%, but it has been off as much as 14% in the session. What's happened is that the Abu Dhabi National Oil Company, or ADNOC, has walked away from a $19 billion takeover offer or deal for the business. Santos has been struggling to find a buyer for quite a period now. Really raises questions about the gas producer's next steps and also the fate of its CEO as well. So we'll watch that stock throughout the session there. Overall, Australian equities are a little bit in the red so far as well. Watching yields fractionally high too, Shery.
And we're taking a look at SoftBank as well, because we have seen Moody's now raising the rating on the company, both on senior unsecured ratings to BA2 because of an improved financial situation, but also the subordinated debt rating from B1 to B1 from B2. So revising the outlook to stable from positive. They have seen some progress in divesting assets and reduction in governance risks. So you're seeing a little bit of a pop there of 1%, Bell.
Yeah, and Shery, also just to get a reaction to what actually is one of the most read stories on the terminal today, and this is Walt Disney taking Jimmy Kimmel's show, or Jimmy Kimmel Live rather, off the air indefinitely, and that's with immediate effect, but it is a backlash to Jimmy Kimmel's comments that he made about the killing of Republican activist Charlie Kirk in recent days. President Trump now is weighing in on this and essentially congratulating the ABC for cancelling that show, and saying that as well his show has been ratings challenged. But as we said, Walt Disney's ABC network taking Jimmy Kimmel Live off the air indefinitely amid that backlash, and that suspension starts with tonight's broadcast. But we'll have more ahead on the Asia trade. This is Bloomberg.
Chair Jay Powell really dampening that Treasury rally that we saw recently, and we have seen now yields push up higher across the board. The 10-year yield, in fact, at one point falling below that 4% level just to track higher. This, of course, as we continue to see Chair Powell's remarks, sort of a Fed rate cut, but also a little bit more balance when it came to the presser for markets to perceive these as very hawkish cut, perhaps. So we continue to follow the latest on the market moves, especially as we'll be watching the JGBs open as well, with, of course, that 20-year auction that was pretty solid. But let's turn to the mortgage markets as well, because mortgage records show U.S. Treasury Secretary Scott Bessent once pledging 2 different homes as his primary residence at the same time. It's a situation echoing the Trump administration's case against Fed Governor Lisa Cook. Bloomberg Investigations reporter Zachary Miter helping us break this story and joins us now from New York. What exactly is the case against Bessent?
Sure. So Bessent didn't do anything wrong. It's pretty obvious from the documents. He didn't mislead his lenders. But he made these 2 promises to live in 2 different homes at the same time. And that's the same thing that President Trump is using to try to fire a member of the Fed board. Now, as you know, in the United States, the Fed is formally an independent body that is not supposed to be answerable directly to the president. And so he's looking for ways to exert more influence over the Fed because he wants it to raise interest rates more swiftly than it has been. And he seized on this idea that one of the Fed governors, Lisa Cook, has made these 2 conflicting promises in mortgage documents. And it turns out that she's not the only person in the U.S. who's done this.
You know, Scott Bessent must be sort of regretting the comments he made on Fox recently, saying that there are people like himself, like President Trump, who think that if people are committing mortgage fraud, they should be examined. Where does this leave, then, the overarching case for President Trump to remove Lisa Cook from the Fed Board of Governors, if what has happened with Scott Bessent also kind of has a lot of hallmarks or similarities to what Lisa Cook has done?
Right. And to be clear, Bessent hasn't committed any mortgage fraud, but it looks like Lisa Cook may not have either. And in fact, there are other people in government who now, because the president has kind of invited everyone to look for conflicting mortgage statements from top U.S. officials, all kinds of people are popping up who have this or similar kinds of discrepancies in their mortgage files. And it creates at least a political problem for Trump in that he's saying this is so bad that he has to fire this Fed official at the same time when other members of his own administration, people he appointed, have the same paperwork problems that Lisa Cook does.
Yeah, at least 2 members of the Trump cabinet thought to have made conflicting home occupancy pledges similar to Cook. But that was really great reporting there. That was our Bloomberg reporter, Zachary Mider. And let's shift tack a little bit to also the tech space, because this has been a big story in the last few hours. China widening its clampdown on Nvidia chips, instructing domestic companies to halt orders for a particular workstation chip that can be repurposed for AI uses. For the latest, let's bring in our Chief North Asia correspondent, Stephen Engel, here with us in Hong Kong. So, Steve, as we were saying in the last hour, this isn't the H20 where we've already seen China sort of encouraging firmly companies not to buy in China, but this is a different chip. Tell us more about it.
Well, again, it's a bit of a blow again to Nvidia, which has had fits and starts with its efforts to sell into what has been a booming AI market, and the firms that want those Nvidia accelerators and chips, and then also at the same time China trying to promote its own domestic industry. So we'll get to that in just a little bit, but the H20 is probably, well, it is considered a much more advanced AI chip than the RTX Pro 6000D, which is the chip that is in focus right now. Essentially, the Chinese Cyberspace Administration telling Chinese companies to stop existing orders and also stop testing the RTX Pro 6000D. This is a scaled-down chip, essentially for workstations. It can be repurposed as an AI chip, but it's more for local inference and local testing. It doesn't have the massive processing speed for massive inference and other capabilities like the H20. And the H20 itself is a scaled back from the Blackwell leading-edge chips, which are not allowed to be sold into China. So again, this could be a bargaining chip for the Chinese as they're in the negotiations with the United States on trade, and also a potential summit between Xi and Trump. You always want leverage, right? But at the same time, it's also sort of an indication that the Chinese don't necessarily need that particular chip. The domestic makers maybe be able to fill in, or in the coming months or years can be able to fill in that space. Alibaba has the T-head AI chips. It's gaining traction, and there is growing confidence that domestic production, at least outwardly, the projection from the government is that they can rely on domestic production.
So what does this really mean when it comes to the possible Xi-Trump summit then?
Yes. Well, again, as I said, there's leverage trying to be gained. So Jensen Huang is, by the way, on that trade delegation to the UK right now. He was asked about this. He expressed some chagrin at the possibility that China is going to scale back or order companies not to buy the RTX Pro 6000D when we've already had the fits and starts with the H20, and they have not necessarily gained traction on the H20 after Trump basically got rid of that export control in exchange for a 15% stake of proceeds, by the way. This is what Jensen Huang had to say. I'm disappointed in what I see, but they have larger agendas to work out between China and the United States. They, meaning China. We can only be in service of a market if the country wants us to be. So, yeah, I think there is a level of a bargaining chip going on here. Bloomberg Intelligence has a take on this. He says they say it's more of a political signal than a technical sacrifice because of those points that I mentioned earlier. There is growing confidence that China can fill in that gap of the lower tier AI accelerators and chips like the RTX Pro 6000D. But again, they're not necessarily at the level of Blackwell architecture from Nvidia. But again, this could be a political negotiating tool right now.
Our Chief North Asia correspondent Stephen Engel there. And some of the other top global headlines that we're following. President Trump has begun his UK visit with a lavish state dinner hosted by King Charles at Windsor Castle. The banquet was also attended by the CEOs of Apple, Citigroup, Nvidia, and Blackstone. Trump meets Thursday with Prime Minister Keir Starmer and is expected to unveil more than $10 billion in new economic deals. But a source says the UK has shelved talks with the US aimed at eliminating tariffs on British steel. Bloomberg's been told that Nvidia is leading a $1 billion funding round for Reflection AI, valuing the New York startup at more than $4.5 billion. A source also says Donald Trump Jr.'s 1789 Capital and DST Global each put in $100 million. The deal underscores soaring valuations in AI and 1789's growing role in geopolitically sensitive industries. We have more ahead. This is Bloomberg.
Well, Tesla is working on a redesign of its door handles that follows a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. The firm's design chief, Franz von Hofshausen, told us Tesla is looking to combine the electronic and manual door release mechanisms, which are currently located separately.
We actually have a mechanical release that's, basically right at the electronic one too, and we're combining the two. So, in the moment that you're in a panic situation, the muscle memory to go to, what is right there. So you just pull a little bit further on the lever and you have the mechanical release. So that's something that we're working on, yeah. And it's in the cars now.
All right, so if there is then a China ban, you're ready to roll that out so that
we're working on
actually the ban I guess the Chinese issue is the flat outer door handle. So would you do something? Would you make a change like Ferraris have that little crease you can reach into? Is there some idea about that on the outside?
Yeah, we're working on it right now and just looking at the details of the regulation if and when that happens, and we'll have a really good solution for that. I'm not worried about that.
It makes sense. I know it's one thing for us adults to know that, but for kids, it's a little bit different to expect a kid to know how to go for a manual release.
Yeah, so the idea of combining the electronic one and the manual one together into one button, I think, makes a lot of sense. It really helps to, the muscle memory of reaching for something every day is there. And so you intuitively just grab the same thing and you're free.
Tesla's chief designer there speaking to Bloomberg. And breaking news at the moment, we're seeing Kiwi 2-year yields dropping about 10 basis points on that rate cut expectation from the RBNZ. We had the economic data, GDP numbers shrinking much more than economists had forecast in the second quarter. Bell, we're talking about a contraction of 0.9% in the 3 months through June. Of course, rate cut bets are really abounding around the world after the Fed cut rates 25 basis points as expected. Markets reacting now.
Yeah, that's right. I think if there was sort of any surprise that we got out of the Fed decision, it was more the unanimity rather that we saw from the committee as well. But stocks just eking out some modest gains this morning following what we had pretty subdued trading on Wall Street. We'll get more details ahead. This is Bloomberg.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do. And the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
And weakness in the U.S. job market highlighted as key concern for Fed officials after that quarter-point rate cut. Ahead of the decision, Bloomberg spoke exclusively with Bank of America Chairman and CEO Brian Moynihan about the challenges employers are facing.
If you think of 23 summer, the Great Resignation, it was very tight. Then it loosened up, and it's more imbalanced now. So our turnover rate in our company is running about 8%. Even in places like tech programmers, of which we have 30, 40,000 of them, we're running in double digits is now in 3-4%. And what that shows you is the bid in the market's different, which then shows you people are being more careful at headcount. And you heard some of my colleagues talk to you about that. So I think the unemployment rate is still low, but I think businesses are being much more careful in managing their headcount for a number of reasons. One is to get by understanding how all the policies that are coming at them fit together. I'm talking about U.S. businesses mainly. And then secondly, they're also making sure that they're careful, and I heard some of my colleagues talk to you about this earlier. As you think about this application of technology, we know what this does. We have half as many people working in the consumer business than we did a decade plus ago. We have half as many people working in operations. We know that as these technologies can apply to our legal department, our finance department under Alistair, our risk department teammates, we know that if we manage the headcount carefully, we will do it. So we look at headcount very carefully and say, don't hire people unless you really need them. Not because we're trying to save money, because frankly, from a human management capabilities, we don't want to have people who won't be able to have a career here. So we just hired 2,000 plus kids from school. So we brought in all those new talent. We'll hire these 10,000 veterans. We'll hire these 8,000 people from community college. But each month we get the right to make a decision on whether we're going to hire about 1,300 to 1,500 people, and we're just managing that very carefully. So I think we're an example of what's going on in the broader labor market. You heard Wendy and my colleagues talk about it. All the companies are trying to manage this and make sure they get the headcount right, because that is a major expense for a lot of firms.
Brian, about a year ago, you were talking to us about the ramifications of AI and the explosion of efficiency. And you said that you think that headcount could remain about the same at the bank, even as the business continued to expand just in total size. I'm wondering if that's shifted, if you still see that as the natural progression of the relationship between the adoption of machine-based learning and the relationship to your headcount.
So there are two things. Now, one, I think the time we were talking, we were probably closer to 216, 17,000 people, or 213,000. So I think we'll be managing this down. But remember, at the same time, we're managing out through operational excellence and efficiencies of applied technology. We are deploying. So we're adding. Wendy's added commercial bankers in all the markets, and Sharon and the team added business bankers in all the markets, and Katie and Lindsay and Eric adding financial advisors and private bankers. So we're adding front-end people, sales traders, et cetera, to keep building out our capabilities. And so there's a reinvestment going on. The key to that is really redeploying people and reskilling them. So when we bring these 2,000 plus teammates in who just joined us in the last month and a half, we have to be more mindful about training them along multiple dimensions than we might have been 2 or 3 years ago. So I think, yes, I think ultimately the human being content of our work product would probably come down, but if we manage it right, it'll be flat to the same amount of people, maybe down a little bit, but all paid more and all being applied to the highest value tasks where, frankly, the machines can't do the work. And that's the important thing. We know what this AI can do in today's world. Erica's been out there for 7 years, 3 billion customer interactions, 20 million customers using it all the time. We see what it could do. We took that and put it in our commercial business. We took that and put it in our internal process. We got other models to help in Jimmy DeMar's business in terms of a thing called Optimus and things like that. There's a lot out there, but what you're learning is there's still augmented intelligence, and that will be what's driving the near-term efficiencies. So yes, I think the headcount management is one of the core tasks that managers have to take seriously.
Let's dig into the outlook for the Fed and markets with our Bloomberg senior editor and opinion columnist, John Authers, joining us in Hong Kong this morning. So, John, really great to have you in studio. And I think it's interesting to also stack up what we just heard from Brian Moynihan there, but more on the micro level. He's talking about how, maybe they're reskilling people, but it sounds like adding more at the front end, back end jobs are disappearing. Yes. Very, very careful about how they manage their headcount. And it seemed like from the Fed's decisions as well, they're very concerned about deterioration in the overall labour market at the macro level.
Yes, and I think the kind of point that Ken Moynihan was making there makes a lot of sense. In that we've had these phenomena of labour hoarding, that companies learned a lesson from the pandemic, that you really make life difficult for yourself if you lay too many people off at once. So hiring has dried up, but until the latest claims data, it looked as though companies were trying still quite hard not to lay people off. Which is another element that makes this a much harder market to gauge. And another very interesting area is graduate unemployment, or people in their early 20s are suddenly, in America it's been a source of controversy that a college education isn't as valuable, as worthwhile as it used to be. But there's what looks like a step change, which you could very plausibly attribute to AI, that better qualified young people are really finding it hard to get a job. They don't show up on layoff figures, but that's where it's showing up. And that's a different... It's a changing structure to the labour market, which is part of why it's as hard as it is to work out whether things really are deteriorating. But you're quite right. That's going to be one of the critical variables to determine where rates go from here.
John, how would you classify the Fed's move this time then? Is it a pivot towards the labor market weakness, or is it just a measured step there, given that, of course, during the presser by Chair Powell, he also talked about a more balanced approach as well?
I certainly wouldn't call it as strong a word as a pivot. There was certainly a possibility entering this meeting that you might have had something that direct. But I think you can tell just from looking at the way markets have responded to it, I think correctly, that this was much more of a measured step. The phrase risk management is well taken. If you actually look at how much the dots moved on average, it's the dots where they're expecting rates to go. The change really is tiny compared to June. Yes, they're expecting to ease very slightly more than they did 3 months ago, but really not by very much. Even though we've now got this Uber dove who has arrived in the committee. So I think this is an incremental step, no more than that, and we're still leaving open. Unemployment also, I do think you can't ever, this is one of the lessons from the last 5 years, you can never safely ignore inflation either, the data, and then the political mess over who is going to run the Fed next year and who is going to choose the people who are on the committee needs to be resolved. Must be resolved in the next few months, but it's still wide open now, and that's the other big. One of the lessons I've learned from today is that matters even more than we thought it did.
I want to pick up on that point because it was obviously one of the big takeaways in the meeting. Yes, you had Stephen Moran that dissented, and that was pretty much expected, but we did anticipate maybe more. Yeah. And you could have seen maybe Governors Christopher Waller, Michelle Bowman as well, given they dissented in the last meeting. How much does that then sort of complicate the outlook for who's going to be the next pick for Fed governor? Right. And also, how does that stack up against what we see in February, which is also the voting for the regional Fed officials as well? It just seems very difficult right now to anticipate what the path ahead looks like.
It is, and there's almost no precedent for the internal politics of the Fed being this complicated and this involved. The single most surprising and significant part of the entire package this afternoon, I think, was the lack of any other dissents. And to his very great credit, Christopher Waller is thought of as the front runner to get the chairmanship. Michelle Bowman is also seen as having a shot. Both of them surely know that voting for 50 bips would have made their chances much stronger. So one can assume that they genuinely believe that they shouldn't do that they're doing what they believe to be the right thing, even though it's might well cost them, if you're a central banker, it might cost them their shot at the biggest job there is. That somewhat surprises me, and it suggests that some of the scenarios we've had over what will happen over the next few months need to be rethought a little. So the really complex matter comes in February when the regional board presidents are nominated, and a majority of the governors, the 7 governors who sit in Washington, can veto them if necessary. Lisa Cook at the moment is the 7th governor. If you remove her, then with the Stephen Myron place, Waller, Bowman, and the new person, you have arguably 4 Trumpista Fed governors who will then veto anybody that they don't think will be loyal to them. I'm not sure that's such a clear... Obviously, whether Lisa Cook is allowed to keep her job, which is entirely a matter of legalities at this point rather than politics or economics, is pretty crucial. But it does make me wonder that Bowman and Waller may be a little bit more principled than some of the analyses I've been reading have given them credit for, that you can't necessarily rely on them to nix somebody who in their view is a perfectly well-qualified economist just because they don't go down well with the White House.
I think it's really delicate balancing out, though. Of course, you've got to manage Trump, but you've also got to manage the internal dynamics on the board as well. That was our senior editor and opinion columnist there, John Authers. And coming up, we're going to be speaking with the EU Justice Commissioner, and that's Mike McGrath, joining us to discuss the bloc's efforts to strengthen alliances in the Asia-Pacific region on privacy as well as data protection. So that's just ahead, and this is Bloomberg.
Take a look at how European futures are trading at the moment. Of course, we saw the euro hit a 4-year high against the U.S. dollar. We had seen the dollar erasing some of those losses as Chair Powell began speaking at his press conference, but the euro still maintaining those gains, given that we are now seeing expectations of a divergent monetary path with the Fed rate cuts and the ECB not perhaps cutting further. We're also looking ahead to the Bank of England policy decision and expected hold set to rein in, though, quantitative tightening. Gilt sales are worsening the volatility in that bond market. And President Trump also beginning his visit to the UK with a group of tech CEOs in tow, where he's expected to announce $10 billion in economic deals. A group of House Republicans also urging Trump to secure a commitment from the UK to drop its tax on tech companies, a levy similar to those also imposed by several EU nations. Let's bring in our next guest, European Justice Commissioner Michael McGrath, who's here in Japan to strengthen relations on issues such as data protection, privacy. Really great to have you in our Tokyo studio. Yeah. Let's talk a little bit about the digital tax issue. Will President Trump now threatening tariffs make it a problem for some of these countries that actually have this levy in place?
So there isn't any EU-wide digital services tax, and as you pointed out, a small number of member states do have such a tax. We have no plans within the European Union to introduce an EU-wide digital services tax. We recently brought forward our proposals for the next 7-year EU budget, the multi-annual financial framework. We have proposed some new revenue sources, our own resources, as we would call them, but a digital services tax is not one of them. It is our view that the global corporate tax landscape is best addressed through multilateralism, and while the OECD reform process has stalled, we do take some comfort from the recent statement by the G7, and it would be our expectation and certainly our hope that by the end of this year negotiations could resume in relation to Pillar 1. So we're not looking too far ahead. Our focus is on a global agreement still. We will work in good faith to achieve an overall balanced and fair outcome, and it's too early to say what the European Union might do in the event that such a global agreement is not reached.
You're of course looking at consumer protections as well, and the EU as a whole, though, still a little bit worried about the safety standards of some of the products coming through e-commerce to the European Union.
Yeah, the overall message there is that if you are selling product into the European Union, you have to respect our consumer protection laws and also our product safety laws. And that is why we are now placing a very significant emphasis through the e-commerce communication we issued back in February on a whole series of reforms. There will be a new EU Customs Authority, a major reform to the EU Customs Code, and we're looking at a number of other changes, including addressing the duty-free threshold, for example. But fundamentally, it is about enforcement. It's about enforcement of existing EU consumer protection and product safety law. A number of actions are underway in relation to some large Chinese platforms in particular, and I will be visiting China in November and engaging directly with the authorities there to emphasise the importance of our consumer protection and product safety laws being fully respected. Unsafe products are not welcome in Europe. If you're selling into Europe, you must respect our product safety and consumer protection laws.
What have been the conversations then, Michael, so far with China on that topic? And as well, how are your issues or the concerns that you're raising there around product safety and quality being addressed? And in addition to that, how are you also planning to work with partners in Japan and also Korea to ensure the safety as well?
Yeah, thank you, Annabelle. And I'm on a mission here to Japan, and I've come from South Korea, and we have excellent relations with both countries on consumer protection issues, also on data protection and data privacy, and also justice cooperation. And those are the areas that are a priority for me on this mission. So we are engaging with both jurisdictions about what more we can do working together to strengthen the dialogue, to strengthen the cooperation, to tackle the shared challenges in relation to the very large volume of e-commerce imports that are coming into our respective jurisdictions. Last year alone, about 12 million small parcels a day were imported into the European Union, with over 90% of them coming from China, and I expect that the numbers this year will be even significantly higher. So you can get a sense of the scale of challenge that this is presenting for our customs authorities, for our market surveillance authorities who are responsible for product safety, and that's why we have to address these issues in a multilateral fashion and engage with our like-minded partners with whom we have so much in common.
So then do you expect the volume of imports or shipments from China to decline if you have that greater emphasis on product safety and quality?
I think we have to address this in a number of ways. We need to step up our bilateral contacts with the Chinese authorities, and we also need to step up our enforcement. And one of the issues that I would like to address in terms of consumer protection and working with colleagues in relation to product safety is the way that we do it within the European Union. Principally, it is a function at member state level. We do provide coordination and support at European Commission level. But I think given the cross-border and inherently transnational nature of this issue, it does make sense for the European Commission centrally to have greater investigative and enforcement powers. And that is a proposal that I'm developing with my team in the European Commission, and we will be bringing that forward over the period ahead. But we are also stepping up the enforcement that I mentioned, and under our Consumer Protection Cooperation Network, and indeed under the Digital Services Act, various actions are underway and quite advanced to ensure that these platforms are obeying the EU consumer protection and product safety rules. And I think we can have good cooperation with the Korean authorities, with the Japanese authorities, given it is a shared challenge.
Have the tone of the conversations with Beijing and perhaps with the rest of Asia sort of changed given the tariffs threatened by President Trump and a more protectionist stance coming from the U.S.?
Well, I think it just makes it all the more important that we engage with like-minded partners who are deeply committed to democracy, rule of law, fundamental rights, human rights, and indeed open and free trade. And so we have had a very successful economic partnership agreement with Japan for a number of years now. We want to deepen that relationship. We want to explore further trade opportunities. We have a new digital partnership as well, and of course a security and defence partnership. And at a time when multilateralism in the world is under so much pressure, it is vital that countries that believe in engagement, that believe in tackling global challenges collectively, that we continue to talk and we find new ways and better ways of deepening the engagement and the cooperation. And that's why I'm here in Tokyo, having come from Seoul, because these these are two key partners for the European Union in the Indo-Pacific region.
In Japan, you also wanted to develop critical mineral supply chains with the Tokyo government. Have you seen any progress on that field?
So this is an issue that, like many others, would have been highlighted as part of the very successful EU-Japan summit that took place in July. And so we're now working through all of the different action points across a whole range of different areas, including in my own area of data protection, for example, where we are looking to broaden the scope of the two-way flow of personal data that we have, which will help to underpin trade flows between Japan and the European Union. And in Korea, we just concluded a very successful agreement now whereby the Korean authorities are fully recognising the adequacy of the EU data protection system, and that means we will now have mutual two-way safe data flows, which is another workout of the cooperation and the partnership approach that we are as an EU adopting in this region. So on critical minerals, on security and defence, on economic and trade opportunities, there is so much that we can do together, and that's the overall message that I'm conveying here on my trip to Japan and to South Korea.
A very busy schedule across Asia. European Justice Commissioner Michael McGrath, really good to have you with us. Thank you very much. We do have more ahead on the Asia trade. This is Bloomberg.
Looking ahead to the market open in mainland China and Hong Kong, some of the names we're going to be watching: SAIC Motor. Sources tell us that General Motors is in preliminary talks to renew its JV with the Chinese automaker. So that name there in focus. The other sector as well as the China tech names, because we saw US traded ADRs of the likes of Baidu, Alibaba continuing to extend their gains. And even though you've seen such a big run up in the Hang Seng Tech Index, valuations still look cheap when you compare them to their US peers. More ahead.